I thought I'd go ahead and demonstrate these three methods of calculating equity capital using some real numbers to illustrate the difficulty of using any of them. I'm using Procter & Gamble, which is probably one of the more predictable companies we have out of the out on the stock market. So Procter & Gamble, pretty simple company to use, but you're going to see that if I did this calculation again tomorrow, I would probably come up with slightly different answers. All right, the current rate on U.S. Treasuries, I can look that up, and it's right around 2.4%. I went and found the yield to maturity on Procter & Gamble bonds by searching out in the FINRA database, or you can also go out on Morningstar. Anybody that collects the information, the market information on bonds, you can use that as a source. So it's public information, and it's about, for a long-term bond, it's about 3.4%. I got their average tax rate, and you're supposed to use marginal tax rate, but their average tax rate is actually pretty stable at roughly 25%. They do a lot of business overseas, which lowers their effective tax rate. I estimated the market risk premium at 11%, and I'll go over where I got that from, which is high by historical standards, but I believe today it really is that high. I looked up their beta using, just Googled it, and I believe I took that off of Yahoo Finance. Their current price was their closing price last Friday, and I just looked that up out on Morningstar. I estimated their dividend a year from now, and I'll go over that calculation separately. But what that gives me is the dividend yield is 3.3%. That's $2.84 divided by 86.50. And then the dividend growth rate, I estimated at 9.8%. And I'm going to go over that in a minute on where that came from. So I got three different estimates of the cost of equity capital. The bond yield plus a risk premium method, that's basically you take their 3.4%, that's the yield on their bonds, and then add to that, how I do it, market risk premium times beta. Okay, so that's the additional risk they have over and above the average stock in the stock market. The CAPM estimate is risk-free rate on Treasury securities plus the market risk premium times beta. So you're actually getting a very similar number in there. Stupid computer. My computer's a piece of garbage, but for $250, I can't complain. So the real difference in how I compute these two is that the CAPM estimate's using a risk-free rate, and the bond yield plus is using the company's actual bond yield, which is going to be higher than the risk-free rate. Different people have different shades of doing that. The discounted cash flow is the estimated dividend for next year divided by current price. That's the dividend yield. And then add to that the long-term growth rate. So to get this one, it's simply dividend yield plus long-term growth rate. And that's the highest one. And that's actually fairly common that ends up being the highest one. There's some technical reasons for it. So which one do you use? Here I just took the average because they're all pretty close and it's a guess anyway. It's an educated guess, but it's a guess. Because I don't really know what the market risk premium is. I can guess, but I don't really know. I have to estimate the total return on the stock market and then subtract today's risk-free rate. Today's estimated stock market returns are actually fairly high from a historical standpoint, and the risk-free rate is fairly low from a historical standpoint. So that's given us a fairly high market risk premium. If I'm trying to do discounted cash flow, I've got to make an educated guess of the dividend growth rate, and I'll show you where those numbers came from. First to the beta. Beta is pretty simple. I gathered data from Morningstar on the S&P 500 stock index, which we use for a host of mathematical reasons, and I only have data going back to 1970, so that's what, 47 years of monthly returns, and I have 47 years of Procter & Gamble's adjusted stock price. That's the stock price adjusted for dividends. I gathered the 90-day Treasury rate and the 10-year Treasury rate for each of those months, and I went out and got those off of the Federal Reserve database. All right, so to calculate a beta, you first have to get returns, and that's the percent change in the S&P 500. That's the change in the stock market, and the percent change in Procter & Gamble. Now, since I'm going to adjust them for these annualized interest rates, I'm going to calculate a 1 month percent change and then multiply it by 12. And that'll annualize it like these interest rates on the 90-day T-bills and the 10-year Treasuries are annualized, stated on a yearly basis. So take that, the October 1st to S&P 500, divide it by the September 1st, subtract 1, that's a percent increase for the month. To annualize that, simply multiply it by 12. Okay, and then I just copy that down. Now, I have like 500 and a bunch. I have 574 observations. I'll only get 573 percent changes because I have to start with one of them. All right, so you lose a degree of freedom. That's technical, and I shouldn't digress to that. But if I took the median value over the entire 47-year period, the S&P 500 earned 11.2% roughly, 11.18. If I look at the last 5 years only, that's closer to 13%. If I look at the last 10 years, it's closer to 6%. And that's because of the Great Recession throwing numbers off. So do you use the entire 50-year period? Do you use the last 5, the most recent? Do you use the most recent 10, 20 years? Different people will do it different ways. It's common to use the last 5 years. Notice what happened with the 90-day Treasury yields. For the last 5 years, they've averaged almost 0, and for the last 10, less than 0.5%. Over the long run, for this entire 50-year period, the median value, the one right in the middle, was right around 5%. And for the 10-year Treasury, you also get those types of differences. So current Treasury rates, and since we had the Great Recession, the bottom fell out of Treasury rates. So they're actually really low today, but the long-term run is like 6.5%. Okay, so depending on the period you use, you're going to get a different answer. Now, if you're calculating capital asset pricing model, what you want to have is subtract the risk-free rate from the total return. That's to get the market risk premium. And you do that for both S&P and Procter & Gamble. So I'm going to use the 10-year Treasury because that's what I do. Some people use the short end, some people use the 30-year. I use the 10-year. So subtracting that out, now I have the market risk premium for the stock market and the market risk premium for Procter & Gamble. And if we look at that, the Procter & Gamble's is lower over the entire period. It's lower over the most recent 5 years. It's right around the same for the last 10 years. Now, how you get a beta, once you have subtracted the risk-free rate from both S&P 500 and Procter & Gamble, is you regress them. And the easiest way to do that is to make an XY graph here in Excel. Pin that. I want to move the chart to a new sheet because they're easier to work with like that. Alright, so all I have to do here is add a trend line. So if I add a trend line, I'm going to go with a linear trend line and display equation on the chart. And of course you can't see that, so I'll make it bigger. But that's essentially the capital asset pricing model numbers that we just come up with. Trying to get this box to move. My crap computer. Alright, well I'll just tell you, it's 0.6161x. That's the slope of that line. That's the beta. Now if I used a shorter time period, for instance, instead of using the entire period, what if I just used the last 5 years? And that's the common practice out there, is to use the last 5 years. Because you want to have it fairly sensitive to recent times. You can see it's around 0.67, 0.66. So that's probably fairly close to what's out there. And by the way, that's also what I saw from Yahoo Finance. They had 0.67. So that's all a beta is you just regress the rate of return on the Procter & Gamble against the rate of return for the stock market. All right, let me turn to estimating the discounted cash flow components. I calculated the dividends and then I graphed them. If you graph the dividends out over time, they're also fairly predictable. All right, that's what an exponential growth model looks like. And I went through a bunch of different calculations here to get, I took percent changes from period to period, from year to year, and notice that they're not consistent. Some years are higher, some years lower. But over this 40 some odd year period, the median, if we're looking just at the year-to-year change, is about a little over 9%. I also took 10-year growth rates, calculated using time value of money stuff, and I calculated a median 10-year growth rate and an average, and I looked at the exponential growth rate. That's letting the Excel calculate it for me. And which one's right? Ain't none of them right. Which one did I pick? I picked a growth rate of 9.8%. I think the dividend's going to be 2.86 next year. The dividend growth has slowed in recent years for Procter & Gamble, but that's because they're doing a lot of stock buybacks. You'll learn about that when you get to one of the finance courses, but they're a substitute for dividends, and I think they'll stop doing that. So I think this is going to build back up to its normal rates in the future. Anyway, that's where these numbers come from. I've got to estimate 9 different ways from Sunday what that growth rate is, and then pick one that looks reasonable. I've got to use the CAPM estimates to come up with a beta, but do I use all 50 years of data? Do I use the most recent couple of years? Do I use 10 years? Do I use 5 years? You'll get a different slope on that line. And by the way, Procter & Gamble is one of the easiest out there to forecast. So if I'm having this much trouble with Procter & Gamble, I'm going to have a whole lot of trouble when I start looking at other companies. And I noticed in a lot of the postings, people are saying, oh, you got to have publicly traded data. Well, you don't, but it helps. You can make these estimates if you can make the estimates with non-public data. They're not going to be as accurate, but they're already not that accurate. All right. I think we'll just that's 15 minutes of yammering for me, but I did want y'all to get some idea of how these are calculated. Different people will do slight different variations on the calculations, though. But this is the concept.